Welcome back. I'm Caroline Woods in for Oliver Rennick. Just a few minutes left in the trading day, about 11 minutes, and it's time for the big picture. For that, let's welcome in the team from Charles Schwab. Nathan Peterson is Director of Derivatives Analysis at Schwab Center for Financial Research, and Cooper Howard is Director and Fixed Income Strategist for the Schwab Center for Financial Research. Nathan, Cooper, great to have you both here with us. Nathan, we'll start with you. I know this is called the bigger picture, but I want to look at the smaller picture to start and just talk about the reversal that we've seen in the stock market today. NASDAQ is back in positive territory, but looked like it was going to be an up day overall, and not necessarily the case unless we get some changes in the last 10 minutes. What happened today?
Hi, Caroline. Yeah, so it looks like what happened, if you go back to Wednesday, we basically got below 30 on the RSI on the S&P 500, and that basically coincided with the VIX getting up in that 1920 level. And I think it's more of a reflexive bounce is what we've seen over the past 48 hours here. And there was a critical support level at 43.30. This was the low in late June and in mid-August. And so we breached that, and then it feels like we came back up to it and basically did what's called a pullback. So when you breach a support level and you come back and you retest it from the underside, our intraday high today on the S&P was 43.33. And so it looks like that's what it's doing. It's a bearish confirmation, but on the bullish side, I will say, hey, we're going to close the books on September. We've got better seasonality that'll be coming towards the back half of October. We're going to have optimism around the Q3 earnings. Let's cross our fingers and hope that we can get some ammunition for the bulls there. And then there is a lot of money on the sideline that potentially could be put to work, but they might be waiting more to see what happens as we get into earnings season.
Nate, let's actually go back and talk about some of the seasonality factors while we try to get this worked out, because September, it certainly wasn't a month to remember, a September to remember, but seasonally, that's not all that surprising. Now, October, with a few exceptions, some big exceptions, has been known to be a bear killer. Do you think that can be the case this October? Can you make the case that some gains are in store?
It's really going to come down to earnings, Caroline. It has to do with our current valuation. We're basically at a forward PE of 19, and every time that we see those yields climb a little bit higher and a little bit higher, this is supposed to basically be reflected in a more fair valuation, which is a lower multiple, meaning equities obviously have that inverse relationship with yields. So it's going to come down to yields, and it's going to come down to earnings. So we know that seasonality is very good. We hear the term Santa Claus rally and everything like that. And the good news for the bulls, like I said, there is a ton of cash on the sidelines, but it needs to have a reason to basically get into the market, because right now, Caroline, you get paid to wait and see what happens with these earnings reports. So it's a little bit too early to tell, but right now it's going to be driven by yields. We're going to have to continue to monitor that. The technicals need to improve. We'd like to see the S&P get back above that 43.30 level, and then let's hear what the corporations have to say here in a couple weeks, and then we'll have a better sense of whether we can get a Santa Claus rally this year.
Okay, Cooper, let's go back to you. I think that you finally have audio so we can hear you here. Nate was just saying how it all is going to depend on, among other things, yields. I wanted to talk to you about the tick higher that we saw in the 10-year yield this week. What's the key takeaway there, and where does it go from here?
Yeah, sorry about that. I don't know what happened there, but I'm glad I'm back. So I think there's a couple key takeaways that we can look at. One is we look at why are yields moving higher? And if we break down the move in the 10-year treasury, you can look at it from Fed expectations, and I really don't think that those have changed much this week. We're still in the camp that the Fed is going to keep rates higher for an extended period of time. I think that that's what the market's also looking at. We saw some Fed speakers today and the other day speak to the potential that they're done hiking interest rates. So I think that that's something that's notable. The second piece is looking at inflation expectations. Inflation expectations, they really haven't changed too much. We saw the numbers come in this morning, and that points to some trending down towards that 2% Fed target in the pipeline. So that's a positive thing. So I think the third kind of catch-all is what's going on with some of the move up in yield. Could be potentially an increase in supply, some concerns that maybe growth is going to be higher than expected. So I think that there's a lot that's out there. The second thing I'd say, as far as kind of what the big takeaway is that now investors can really earn attractive yields on their fixed income portfolios. We think that it's a opportune time to lock in these longer term yields, because we do think the Fed is going to be cutting rates eventually next year. Might be pushed out a little bit, but we do still expect them to cut interest rates. So we are suggesting to our investors, Caroline, to lock in some of these attractive yields, extend duration, and take advantage of the move up in yield. We saw the 10-year, like you said, a big move up. It's now the highest that it's been since 2007.
Wow, yeah. All right, so Nate, in the nearer term, obviously earnings are the next big market catalyst in your view, but next week we do have the jobs data, assuming that the government actually isn't shut down. That could change if we do see the government shut down. Oliver was making the case on MTL that maybe it wouldn't be such a bad thing for the government to shut down because it'd be less data to kind of confirm higher for longer rates. What do you think?
Yeah, I mean, if you look at the initial, kind of more the leading employment data, it's those initial claims. And we saw, 2 weeks ago, it was 201K, revised up to 202K, and then it was 204K this week, both coming in well below estimates. That 202 figure was the lowest since January. That still speaks to a tight labor market. I think the Fed has kind of been okay with having this tight of a labor market. They want stable employment. They would like to see some slack there, but they're more focused basically on that trajectory of inflation. And I think, even if they are done with raising rates at this point, the question is going to be, for how long are they going to keep the restrictive rates in place? So how long is this 10-year going to be hanging out around here? Because let's keep in mind, the higher oil prices, that's a tax on the consumer. Yes, that will be good for the energy sector in terms of corporate profits, but then the higher rates are also a tax on the consumer as well, in addition to the corporations. So it's going to be, how long are we going to be hanging around this restrictive policy? Because that's directly correlated to how we can then justify the valuation on equities.
Cooper, going back to the government shutdown for a second, though, we know the Fed is very data dependent, and if the government shuts down, it won't get those key jobs and also inflation data that it needs to dictate policy. So what could the impact on the Fed be?
I think that if you look at what the impact on the Fed could be, I think that it raises the bar in terms of another rate hike. The reason I say that is that let's assume that they do go through with another rate hike this cycle and the government shut down, so we're not getting those data points. I think that would be highly scrutinized and kind of looking at it and saying, well, how can you increase interest rates when we really don't know exactly what's going on out there? So, in totality, I think that it just raises the case for the potential that they're going to continue to hold at these levels.
All right, we'll leave it there. Cooper, Nathan, thanks so much for joining us. Always good to get your insights.
Thank you.